Welcome to Pinvest TV, India's first real estate channel. Common equity shares and compulsorily convertible debentures are both financial instruments companies use to raise capital. However, they differ significantly in terms of ownership, returns, risk, voting rights, and conversion features. 1. Nature of ownership. Common equity shares represent ownership in a company. Shareholders have a claim on the company's assets and earnings and usually have voting rights, enabling them to influence company decisions. Returns come in the form of dividends and capital gains. CCDs, compulsorily convertible debentures, start as debt instruments. CCD holders are initially creditors and do not have ownership or voting rights. However, CCDs convert into equity shares under certain conditions, providing the holder with ownership rights at that point. 2. Returns. Common equity shares, shareholders earn returns through dividends, a portion of the company's profits, and capital gains, when share prices increase. The value of these returns is tied to the company's performance. CCDs, holders receive fixed interest payments, similar to regular debentures, providing a steady return. Additionally, if the debentures are converted to equity, holders can benefit from capital gains. 3. Risk and security. Common equity shares carry more risk. If the company performs poorly or goes bankrupt, common shareholders are among the last to be paid after creditors and preferred shareholders. CCDs offer more security as holders are initially creditors. In case of financial trouble, debenture holders are prioritized over common shareholders for repayment. However, this security can change after conversion into equity shares. 4. Voting rights. Common equity shares typically come with voting rights, giving shareholders a say in corporate governance. The number of votes often correlates with the number of shares held. CCDs do not grant voting rights until they are converted into equity shares. Post-conversion, CCD holders acquire the same voting rights as common shareholders. 5. Conversion. Common equity shares lack a conversion feature. Shareholders buy and hold the shares directly. CCDs are designed to convert into equity shares based on a predetermined ratio and conditions outlined in the debenture agreement. This conversion can be triggered by specific events or a set time frame. Summary. In essence, common equity shares and CCDs serve different purposes and appeal to different types of investors. Equity shares provide ownership, voting rights, and potential for high returns, albeit with higher risk. On the other hand, CCDs offer more security initially as a debt instrument, fixed returns through interest payments, and the option to convert into equity, balancing between the features of debt and equity. The choice between the two depends on the company's capital raising strategy and the investor's risk tolerance and return expectations.